What Do We Do? A podcast discussing wealth management and financial planning, introducing listeners to the leaders in our community. Hosted by the founder and CEO of Great Lakes Wealth, Dewey Steffen, alongside WWJ Midday News anchor, Brooke Allen.
Hey, I'm Brooke Allen. Our goal with the What Do We Do podcast is to educate listeners on topics that impact your financial growth, your retirement, and your lifestyle.
And I'm Dewey Steffen. Join us twice a month as we welcome some of today's leaders in the community for conversations that can help with investment decisions so you can plan for and live your best life.
Here's Dewey Steffen alongside Brooke Allen.
Hey, I'm Brooke Allen. So happy to be with you on What Do We Do? Of course, season 2, episode 20, number 62. And you know, things are just winding down. Summer is almost here, and yay that, Dewey.
Brooke, it's great to see you. Did you say it's episode 20 of season 2, number 62?
Yes. Can you believe it?
I can't believe it. Time flies when you're having fun.
It does.
And you're right. It's June 15th, and we're getting ready to the dog days of summer.
Can't wait.
You can't wait?
I can't wait.
Okay.
How about you?
I guess I can't wait either. I am excited. Absolutely excited for summertime. Yes. So that's fantastic. Summer is here. Let's get into it.
All right. We are actually going to be taking a break, like stocks, right? I mean, you have a whole saying as far as what investors do during the summer, and it's no different than having a summer vacation. Yes.
So season 2 will be wrapping up here at the end of the month. Absolutely. So we're excited about that, but we won't talk about that, I guess, right now in detail. But to your point, Brooke, there is this old adage on Wall Street, which is sell in May and go away and don't come back until after Labor Day. So we are into June, but according to that old adage, you can leave the market or understand that the stock market and the other markets really won't do much in the summer because everyone is away. They will play and they will not invest for success. They will go away and come back after Labor Day. So historically, the stock markets don't do much in the summer. And so, yes, it slows down, but I don't know if that's going to happen this year. But for our listeners, our viewers, we want to give them a playbook so that no matter what's going on this summer, whether we're in our chairs or we're at the beach.
That sounds good.
Right? Or we're up north in northern Michigan, or we're traveling around that we talked about in our prior podcast. We want to make sure everyone is set up for success in summer of 2022. And I think we've got top 11 lists to help us get there.
So do you think, actually taking a break from summer, I know you will go on vacation, I'm sure, but you're not going to be looking at the stock market or anything. You always will. I know you, right?
Yes.
So you're always working.
Come on, 24/7. Right. Money never sleeps,
exactly.
Brooke. Money never vacations. Are you kidding me? Compound interest. Let's go.
All right. So we have a list. 11, right? You love 11.
The top 10. Top 10, but who wants to be average with a top 10 list? Everyone does that.
Right.
We want to give a bonus.
Exactly.
We want to do a top 11. One better than 10 is 11. So we have a top 11 list on how to invest for success of summer 22. Yes.
Okay.
Indeed.
All right. So kick us off.
Well, before we get into that, I would like to tell all of our viewers and all of our listeners that the What Do We Do podcast, Brooke, is over 35,000 downloads. 35,000. To me, that's amazing. However, I also want to tell you that we are over 250,000 total views on social media. Do you believe that? 250,000 views of us talking
exciting.
About investments, talking about life, talking about everything that matters financially. To me, that is simply amazing.
It is amazing.
We have this new platform that we started called TikTok. Have you heard of it?
I have.
TikTok is the platform that has launched us from 35,000 to over 250,000. So we are so excited to be sharing more with more and more people. And so we're going to ask all of you viewers, all of you listeners to please subscribe, like, download, and absolutely share, because this podcast podcast is all about community. And the mission of this podcast, Brooke, as you know, is to help the community invest for success and be healthy, wealthy, and wise. So we want to thank everyone for their support so far. And as we always say, we're just getting started. So with that, yes, let's get into this list. So I'm going to have a little fun today too with you, Brooke.
All right.
As we go along, I'm going to throw little quotes out there, little Wall Street adages, kind of like sell in May and go away.
Okay.
I'm going to ask you if you can kind of decipher what they mean and or maybe who said it, if it's that popular. Okay.
So it's like Jeopardy. What are we doing?
Yes, sort of, kind of like it, right?
All
It's
right.
like a quiz in English class, maybe,
All right.
right? Or English
All right, let's
lit,
do this. I
something
got
like
it.
that. All right, so we're going to talk about, again, the end of April, April 30th. That would be the day before May 1st. Sell in May and go away. So we have some numbers for the markets this year through the end of April.
Okay.
And then we're going to talk about, again, where we were through the end of April, and then from where May 1st through now, June 15th, through the summer and coming back, in October. So through the end of April, it has not been a good year.
No, it has
not. We know this, right? The risky investments, we're going to categorize these things as risky or safe, because I also have a little tidbit of information with this safe stuff. Okay. Maybe it's not so safe. You know what I'm saying? So anyway, through the end of April, risky investments, the S&P 500 was down 13% in basically, a quarter in a month, 4 months. S&P down 13. The NASDAQ, the riskier of the markets, if you will, in the U.S., down 21%. At that rate, times that by 3, you're going to be down 60% by the end of the year. So we hope that these trends don't continue, okay? The Dow, which is the safest of the 3, go back to a prior podcast, we talk about that, is down 9. And this other category called marijuana, the cannabis index, down 26. And even this category called cryptocurrency, and we use Bitcoin as the indicator there, if you will, down 16. So we can even ask, is crypto safe because it's digital gold? Supposed to be safe. I mean, come on, it's a new currency. Currency is good, right?
So hot, right?
So hot. Well, it's down 16% just in 2022 from January 1st through April 30th. So with that, that's kind of setting the stage of where we are, okay? Heading into the summer, as we talked about. Then you have safe investments. What is known as the safest investment out there, year in and year out, day in and day out, Brooke? What would you say?
Cash.
Cash. That old adage, cash is king, right? When I've said all year long, cash is trash. And I'm telling you, cash still is trash, okay? With inflation where it is, which is over 8%, by the way, cash makes you zero. So maybe for the short term, cash is doing better than these equity markets, but it was not the case in 2021. It was not the case in 2020. It was not the case in 2019. So for the first 4 months of this year, plus where we are now, okay, maybe cash is doing better than some of these equity markets. And that, again, maybe cash is a tactical, place to keep some of your assets. But long term, cash is still trash. But in the short term, as you said, cash has done well, returning zero.
Correct.
And then what would be the next safest investment that universal that most people would say? If you don't have stocks and you don't have cash, what's kind of the other big 3? Big one of the big 3.
Your house.
No. Stocks, bonds, and cash. So bonds. Would bonds be known as the safer investment than stocks?
Yeah.
Right?
Yeah.
And you would think that the bonds would be safe, meaning they go up. Bonds go up when stocks go down. That's kind of what I was taught when I entered this business. Fair enough?
Yes, I think you've said that before, right?
Yeah. So did bonds go up through April? No. They were down almost 10%, everyone. 10%. On bonds. So you have S&P down almost 15 and your bonds down 10 and your cash at 0. So if you just have stocks, bonds, and cash, did you have a good start of the year?
You're probably staying home for the summer.
You're not doing too well unless you sold the rips, as we said, buy the dips and sell the rips. Maybe you did that earlier and took a little cha-ching off of the investment table. But with that, there are other safe investments, Brooke. So although bonds have not done what you would want them to do as a ballast or as a hedge against your stocks because they went down also, we actually said that was going to happen. We said that overall, when rates go up, bonds go down. And we did not know what was going to happen with stocks, but we did believe the Fed was going to raise rates. So when rates go up, bonds go down. And they've just started that exercise at the Federal Reserve. So we believe they will raise rates the entire year in 2022. So we think bonds have the opportunity to go even lower. So we would say bonds are bad, but that's a safe investment. So other safe investments would include T-bills and CDs. So a 6-month T-bill, which would be what we're going to talk about for the summer. So investing for the next 6 months, let's say, T-bills are currently paying 1.37. Better than cash.
For sure.
Right? CDs are actually only paying on average 0.09 according to bankrate.com. So you have to choose. You want a CD at 0.09 or do you want to go find a 6-month T-bill at 1.37?
I'll take the T-bill.
Take it, right? You just got to do a little extra work. Treasury.gov and get yourself a T-bill or go into your local bank. What else is safe out there, Brooke? What would you say?
Well, we know credit cards are not safe, right?
Credit cards are not safe. No,
especially with the interest rates and everything else.
Investments.
Right?
What would be a place to invest? Credit card is not an investment unless you own the credit card company.
Well, right.
Maybe you get a credit card swipe machine and you get 3%. That'd be a good side hustle.
That would be a good side hustle, right?
But, no, in the safe category, let's say gold. Gold, if everyone listens to season 1 of the What Do We Do podcast, I love gold, all things that glitter. Gold, I believe, is safe. It's a hedge against inflation. It's a hedge against volatile markets. And my gold came to play in 2022. Okay. So gold is up 4.5% through the end of April. And I will tell you, with inflation increasing, we have targets of gold above 1,800 an ounce, above 1,900 an ounce, into the low to mid 2,000s an ounce. So I believe that gold will continue to do well in the future. So we'll talk about that in a moment. But for now, gold as a safe investment did okay so far this year.
Okay.
Fair enough.
Right.
Right. So stocks are down. We all know that. Your bonds, bad. That's no bueno. But gold, CDs, T-bills, hanging in there.
Right.
Okay. What else has done really well in 2022?
Well, surprisingly, cannabis was down, right?
Cannabis was down.
So cannabis is down. Bitcoin is down.
What's like the number one investment that everyone's talking about so far this year? It's a pain at the pump, but if you own this investment, you are
Are you talking about oil?
Black gold, Texas tea. Yeah, you heard about this?
Oh, yeah.
Yes. So oil is up 38% year to date for crude, or through the end of April. So you have an investment that's up 38%. We said in one of our prior podcasts that the playbook for 2022, commodities would do well, and we were spot on so far with that. So oil up 38%. So you got stocks down. Bonds down, cash even, throwing a little bit of gold, throwing a little bit of oil, even a little bit of that Bitcoin, a little bit of that cannabis, you would be doing okay. You'd be hanging in there.
Right. And
that's where we are. Right. Now we want to know about where we're going. Okay? So I'm going to start with the first quote. How about this?
Oh, gosh, here we go.
Who said you need to be fearful when others are greedy and greedy when others are fearful?
Warren Buffett.
The Oracle of Omaha. Ding, ding, ding. Ring that bell. Okay, so that's right. Warren Buffett said that. Now, what does that mean? Be fearful when others are greedy and greedy when others are fearful.
It's kind of doing the opposite, right?
Doing the opposite.
Of what you're seeing. Well, if you're afraid, then it means maybe I should invest.
Okay. Right? So we talk all the time off air about this is bad. It's bad. Oh my gosh, what's going on? Everyone's freaking out. What are we doing? What do we do? What do we do? Right? Well, Warren Buffett says the more people freak out, the more you should start getting your money together and let's go.
Right.
And the more that
game time.
Right? And everyone's talking about how easy it is. Oh my gosh, you should get my phone out and check on my crypto portfolio. And everyone tells you how easy it is. Oh my gosh, look at this. It's made $8,000 in 2 seconds.
Right. When
they start talking about that, you need to be prepared to run for the hills. Right. That's another one that I always say, which is the masses are the asses. Okay.
Can we say that? Or
we just did.
Okay. All right.
Okay. So with that, be fearful when others are greedy and be greedy when others are fearful. Where would you say most investors, the sentiment, that's a word we use on Wall Street, where would you say the sentiment is right now? Is it in the euphoria and greedy mode, or is it in the panicked?
It's the panic mode.
The panic mode.
Panic mode, for
sure. Fearful.
Yep.
So we're going to be greedy.
Okay.
We also believe it's not time to go all in because we believe people will be fearful longer, and we're not at extreme pessimism. That's the other word we use on Wall Street. pessimism. We do not believe we're at extreme pessimism yet. So we are cautiously optimistic where we go from here for several reasons. One is the equity markets are down over 20% on average, and that is considered, what is that? We talked about that before, Brooke. If an investment is down 10%, what is that called? Do you remember?
Bad.
That's what she said last time.
That's what I said last time.
Yes, it's bad, I guess, perhaps, maybe for the short term. But it's also considered a correction. Okay, down 10% correction. What's 20% down called? A bear market. Bear market.
Oh, and I heard that term earlier.
Yeah, you heard it last time we had a podcast. Okay.
Well, I know, but I've heard it a lot more since because it was kind of a moment where, are we in a bear market now? Are we not? Right?
Yes. So we're in bear markets for sure on many asset classes. We're not in a bear market in oil, are we?
No.
We're not in a bear market in gold, are we?
Nope.
No, but we are in many of the equity markets. So that happens. But again, every time it happens, everyone panics. Everyone freaks out. Everyone says, "Oh no, I want out of here." When you're supposed to say, come on, come to Papa, come to Mama. It's almost go time. Right. So we want to invest for success. So with that, we're going to start our top 10 plus one bonus, the top 11 list for investing for success in 2022. Okay.
Okay.
So with that, you need to know what kind of investor you are. Are you a investor that just wants to survive? So that's one versus you want to thrive. Okay. Are you trying to make a killing? Or are you trying not to get killed? There's two different strategies if you're a conservative investor or an aggressive investor, okay? So we're going to stay with the conservative ones first. If you're a conservative investor, you might want to keep your cash. You might want to do these other things that are not taking many risks. But we're going to talk about both conservative and aggressive. Risk takers, this might be the time to 2x your return. Okay. That means double it up. Okay. So number one, safety first, no matter what kind of investor you are. And we've said this goes on no matter what is happening. You need to have cash reserves.
Right.
Back to a little bit of cash can always be king or queen. Okay. Right. And that's 3 to 6 months of emergency expenses. That's number one. Before you start doing anything else, you need to make sure you have your budget, you make sure you have your expenses, and you have 3 to 6 months stashed away in case something happens like COVID, in case something happens that's kind of going on now, prices go up, your wages aren't there. This thing called inflation is a bear.
Just bad,
it's
right?
a bear.
Yeah.
Woo. Okay. So 3 to 6 months of cash on hand. Okay. Then number two, we talked about deal with debt.
Yes.
Deal with debt. Another phrase on Wall Street, don't fight the Fed. And the Fed is trying to raise rates. It's trying to squeeze the economy. And when they're trying to squeeze the economy and slow it down and make inflation come down and all the things they're doing, that is not accommodative. So when they're not being accommodative, we know that there'll be some pain for investors in the short term, particularly stocks and bonds. But you don't fight the Fed, especially with your bond investing. So deal with debt. Interest rates are going to go up. So any debt you have above 10%, you better pay it off and you better refinance it so you can restructure your debt. You know that people out there are refinancing their mortgages, right? Rates were down to 3 or sub 3 on mortgages. Yeah. They're now about 5. So you better lock them in if you haven't and get away from variable rate mortgages and get into fixed ones. Unless you're a sophisticated investor, then you can go and do ARMs and you can do strategic approaches to your debt, okay? But for the common investor, get fixed rates,
for sure.
Pay off bad debt, deal with debt, and 5% and above, you should make it a goal to wipe that off because rates are going to continue to go up and up and up. And some are saying they want mortgage rates to go up to 7 or 8 to get us back to where the economy will be on an even footing, especially with inflation. Okay, so does that make sense?
Yeah, it does. So paying off debt, I mean, we're talking if you put something on your credit card, pay it off that month, right? I mean, don't carry it over because that interest rate is going to go sky high on you.
I'm going to tell you about 2 ways you can be guaranteed to make the mother load this year. Okay. I can guarantee you how to make 29.99% on your money, Brooke. You know how that is?
Tell me.
Pay off your credit card in full. I can guarantee you save 29.99% on your money by not having that credit card. Pay it off. There's a 29.99% return instantly. Boom.
It's gone.
Gone. Fair?
Fair.
So yeah, do not carry any balance on your credit card. That's always bad, but especially now, and don't be putting more on there and levering up because you're trying to make ends meet.
Right, right. You know, people at the pump are freaking out and they need to pay it, so
Yeah.
Okay. All right.
Like Brooke always tells me, live within your means.
Yes, Dewey.
Okay, right? Okay, so that's that. And I'm going to tell you one other way you can make a guaranteed 9.62% on your money, but I'll save that for a little later in the show, okay?
Okay.
All right, so that's number one. Number two was don't fight the Fed. Number one was safety first,
Right.
cash on hand. Number 3, 4, 5, and 6 are not investment strategies, but they are awesome strategies for the summer to help you be successful. The first one is max out your retirement accounts. While the markets are down, go and fund your Roth, go and fund your traditional IRA, go and fund your 401ks. Okay. So use this summer, the next 6 months from again, May 1st through the end of September.
September 30th, my birthday.
Okay.
See?
Yeah. So we're going to talk about this 6 months. So in the 6 months, go ahead and fund your Roths for the year, your IRAs for the year, and your 401ks for the year. Buy low. And then also the election's coming in November. We don't talk about it today, but I kind of think that things will, become more predictable the closer we get to the election. Wall Street hates uncertainty. There's another quote.
Right.
And I think as we get closer to the election, you will see that things will not only just stabilize, but they'll start to move in that direction higher. So that's another one. Number 3. Number 4, this is a good trick for everyone out there. If you have traditional IRAs, consider converting them into Roths. Have you heard of this?
I have not.
Okay. Well, a Roth IRA means that once it's in a Roth, it's tax-free forever. So if you put money into a Roth now, you don't get a tax deduction. You just don't have to pay tax later. Well, a lot of people didn't have that option when they were doing IRAs, traditional IRAs, a long time ago. So they have traditional IRAs or their 401k. When they retired, they rolled it over into an IRA. So they have these traditional IRAs. You're allowed to take that traditional IRA and convert it to a Roth IRA, and you just have to pay the tax now. So pay the tax on the value now, and then it goes into this Roth, and you are tax-free forever. Well, when the stock market was at an all-time high, and you did that, you'd have to pay that much more in tax.
Right.
Well, that portfolio is now down maybe 20% or more. It's a great time if you were going to do it before. Now you do it now. You actually save yourself 20% in tax.
Wow.
That's a big deal.
That is a big deal.
You got that one?
Good advice.
Convert your traditional IRA to a Roth. Heck yeah. And the next one, this is for your kids. Contribute to those 529 plans.
Yep.
Put that money in. If you're trying to fund your kids' college, your grandkids' college, your own college, put that money in and go into riskier investments. This is the time. Buy low, sell high. You follow me?
Yep.
Okay. And that's number 5. Number 6, love this one.
I do too.
Start your side hustle ASAP. You better have at least one. You know, the average millionaire has how many streams of income?
7.
The average millionaire has 7 streams of income. How many does Great Lakes Wealth think everyone should have? 11. We love that number 11. Don't be a perfect 10, be a perfect 11, right? So yes, so go and start your side hustle. It is summertime, right? Mm-hmm. So what do they call it?
You could walk dogs. You could, there's so many things you could do.
They call it a summer job.
Right.
Why do you got to just have one?
Why not
You
have
can
5?
Uber. You can Uber Eats. You can
DoorDash.
more. You can mow lawns. Like you can get an online business. We actually have a podcast of all the side hustles out there. So go check out that episode 100%. Okay. So start your side hustle. There's an employee shortage. You can get a second job. You want to make ka-ching. That's cashish. You can. Now is the time.
Hey guys, it's Brooke. I want to take a minute to talk to you about Dewey Stephan and his great team at Great Lakes Wealth. Do you feel overwhelmed managing your assets? Well, Great Lakes Wealth offers Wall Street solutions with Main Street values. That is really what they are all about. They will help you develop a custom financial plan utilizing all of your assets and keeping your goals in mind. That is what Great Lakes Wealth is all about, helping you and your family achieve your financial dreams. So go to greatlakeswealth.us to schedule an appointment today and tell them Brooke sent you.
7, 8, 9, 10, and 11 are all about investing strategies. So get your pad of paper, get your pencil, and we're going to get into it. Okay. Number 7, for conservative investors, bonds are bad. I said that. Okay. Well, there are 2 categories of bonds that you can consider. Okay. Any idea what they are?
No.
Okay. Well, there is one that's called a TIP. I'm going to give you a tip.
Oh, see?
Okay. Treasury Inflation Protected Security. So it's a bond issued by the federal government that has the word inflation protection in there. So the rate changes as inflation rates change. So if you're going to buy government bonds, try to get them that are linked with an inflation indicator.
Okay.
Fair? So those are tips. So if you are a conservative investor, still don't just go any old bond. Don't go buy any old bond. Look for some tips. Okay. And the second one, this is for you. This is the tip of the day. The Dewey's tip of the day. Okay. Right now, you can get a Series I bond from the U.S. government, and it is paying 9.62% interest. Do you believe me?
I do not.
I don't even believe myself. But this is an opportunity that is currently available. The U.S. government has these Series I bonds, and they are literally paying a coupon or an interest payment of 9.62. Do your homework. It's only for 6 months. I think it goes until like August or something this year, and then it will reset. Well, even if it resets to zero after a year, 9.62 and zero is still an average annual of 4.31. So still better than anything else, but I don't think it's going to go to zero, frankly. They've never been zero before, but this is a 30-year bond, but you can cash it out after 1 year. You lose a little bit of interest, but if you keep it for 5 years, there's no penalty. And 9.62 is an amazing rate of interest right now. What's the catch? You're supposed to say, Dewey, what's the catch?
I was just going to.
Yeah. So a couple catches. One is it's a 30-year bond. There are some penalties if you get out, especially before 1 year. So make sure you do your homework and know what you're doing. The other catch is there's only a maximum of $10,000 you can put into it. So you can't go squirrel away $1 million and hide it and make that 9%. So there's a maximum of $10,000 per individual, and you have to go to the Treasury's website to buy it electronically. You can do it paper form, but I think it's only a $5,000 maximum investment that way. So you have to go online, and it's only a $10,000 max. But money's money.
For sure.
9.62 guaranteed. Let's go. I'm in.
Me too. Sign me up.
Do it. So that is number 7 is bonds are bad. Look for tips or those I bonds. Okay. Number 8 is invest for success. Period. Get some of that money in the market. Okay?
Okay, but people are going to fight on that because, they're seeing it's down.
So you're supposed to buy low, just like we said. Well, here's another trick. So DCA, what does that stand for? DCA. We've talked about it before.
We have. I know. It's been a while. Tell me.
Dollar cost average. Dollar cost average. So for the next 6 months, figure out what you would put into the market if it was the perfect time, divide it by 6, and put that in on the 15th of every month over the 6-month period. Since we're into June now, divide that by 4 months. So does that make sense? If you have $50,000 to put in, divide it by 5 months and just put $10,000 in. And so you're buying, whether it's up or down, up and down.
You're just still buying.
You're still buying. If it happens to be higher, you're not buying as much. If it happens to go lower, but over again the next 6 months or the April to end of September. The 6-month period of summertime, you can put it in 1 day. I wouldn't recommend that, to your point. So dollar cost average, but invest for success. Get into the markets. Again, the S&P's down about 20%. The NASDAQ's down around 30%. Your cryptos are down 20%. All of those equity investments are negative. So it's time to buy low. You just have to do it. Back to Warren Buffett's quote. Be greedy when everyone is fearful. Cool. Okay. So then number 9, besides DCA, which is what? Love it. Brooke, I just stumped the teacher. Okay. Dollar cost average.
Got it.
Besides dollar cost average, you can buy stocks that pay dividends.
Okay.
Dividends matter. This is another place where cash is king because dividends come from companies that pay out part of their what? Profits. Yes. Pay it back out.
Right.
That's cash.
You just get those checks.
Right. And so that means a company is healthy,
right? Making
some money and paying it out. And so actually you can reinvest the dividends too because those stocks are still probably down. So I really wouldn't take the cash. Okay. I would probably reinvest it. Again, talk to your financial advisor for your specific situation, but dividends matter this year. So besides just buying any old stock, look for ones that pay dividends. Dividends matter. That's number 9. Number 10, be private.
Yes.
What does that mean?
I'm not going to tell you anything. No.
Right. Keep it a secret. What does it mean? Private. Private investments.
Private deals, right?
Private deals. Private equity. Private debt. Some call it private credit. You also can call them alternatives. Okay, so this is the fancy pants Wall Street world. The private deals. I want the private deals.
So exclusive deals, private, same thing.
Yes,
right?
exclusive and private. So find yourself a financial advisor that can get you access to private deals, but make sure certainly that you do your homework and that they are appropriate deals for you. You either have to be a qualified investor. Look that up and see what that is. You have to be an institutional investor. You have to be an accredited investor. So there are different types of categories of investors to qualify for some of these private investments, because usually they're illiquid, meaning you can't get your money back. You put it in, it's gone for a while. But that's, again, how you can do very well in terms of not losing with bonds by buying private credit, or also having leveraged returns on the private investment. That would be like buying a company before it goes public, that sort of thing. So very important. So be private this summer. Don't tell anybody your business, but just go find a private business and put some money into it. How's that sound?
Sounds good.
Okay, so that's the top 10.
Okay.
But are we done?
Nope.
No.
Always an 11.
Yes, we have that bonus, number 11.
Exactly.
Okay. 2022, and I said this on a prior podcast, 2022 is going to be hard. And what did I mean by that?
Hard assets.
Hard assets. And it is hard, no doubt about it. What do you do? What do we do? But it is hard assets. What are some of those hard assets, Brooke?
I would think real estate.
That would count, yes.
Oil.
Yes. Commodities.
I'm
Heck
on a
yeah.
roll.
Yes. Gold, silver, commodities, real estate, hard assets. They are a hedge against inflation. That is the big buzzword. That is why this market is all messed up. Inflation is here. The Fed is raising rates. And so invest in hard assets. And typically investors are always underweight hard assets because stocks, bonds, and cash rule the day. Well, stocks are down, bonds are down, and cash doesn't pay anything. So you got to find alternatives. Real estate was kind of in that category, but you need your gold and precious metals. I'm still not convinced that crypto, also known as digital gold, counts as a hard asset. I've been having some conversations with some that think it does, and I'm like, no, it's not a store of value. No, it's not a payment of exchange. It's a speculative investment. So go ahead and get a little bit of that, and you might do well. We're still positive on cryptocurrencies with a small under 5% weighting in your portfolio. That'd be the same thing with cannabis. That'd be the same thing with anything that's in the aggressive speculative camp. You should be diversified, long-term investing, invest for success. Makes sense to me.
For sure.
Okay. I'm going to ask a couple quotes, then we're going to wrap up the show.
All right. Boy, I feel like I've been taking a final exam this whole
Yes. Well, I talked fast. There was a lot to get to. So I guess, do you have any questions on that? Any comments? Anything that made awesome sense or made no sense?
No, you always make awesome sense, honestly.
I love that. I always make awesome sense. Fantastic. Okay. Well, this is my favorite quote of all time when it comes to investing.
Okay.
I've said it before, and I'm going to say it again. When the facts change, I change my mind. What do you do, kind sir? And I've changed it to you do, kind ma'am. Okay, all about equality around here.
Right,
but
for sure.
Who said, when the facts change, I change my mind?
I was an English economist.
Yes, John Maynard Keynes, the
Yes.
father of Keynesian economics. Heck yeah. So again, be ready to change your mind.
Right.
Don't be so stubborn. And
Okay, so is that the same thing as being flexible?
yes,
Okay.
for sure.
All right.
Absolutely. You have to have an idea of what you're doing, but if you're at a stoplight and it's red, you're supposed to stop.
For sure.
But when it turns green, the facts have changed. You must go.
Right.
Right? If it's red, people are honking at you. Are you going to go?
No.
No, unless you want to. No, unless
Right.
no. So
No.
when the facts change, I change my mind. What do you do? So again, be flexible and be aware and do your work.
Right.
Right. Okay, I love that one. This is one of my favorites. It's also one of my favorites. This is a longer one. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and they die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Okay, so who said that?
Sir John Maynard.
Sir John Templeton.
Oh, I was so close.
Yes. Okay. Sir John Templeton. Okay. He's also one of the fathers of investing. And he said, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Okay. Bull markets, we didn't even talk about. A bull market is a good market. A bear market is a bad market. Right. And we are in a bear market with some things. So are the markets right now pessimistic, or optimistic, or skeptical, or euphoric?
Oh boy. I would kind of say skeptical because the market hates uncertainty, right?
Yeah.
But pessimism is probably the right answer.
I think so. So that's, again, when they're born. So buy. When things are euphoric, that's when it's over. Get out. When things are in the toilet and you're pessimistic and you just don't want to do it, it's not worth it. You're just extreme pessimism. This is when you get in.
Right.
Sir John Templeton, one of the legends, and Warren Buffett, the Oracle of Omaha, basically saying the same thing. Hello, can we go with the flow?
Right.
Okay. I like this one too. The biggest risk of all is not taking one.
And how true is that?
Right. Well, you got to invest for success.
Right.
So who said the biggest risk of all is not taking one? You haven't heard of her unless you really are deep into investing. Her name is Melody Hobson. She's the co-CEO of Ariel Investments, and she's amazing. And that quote says it succinctly. The biggest risk of all is not taking one. So you have to, what do you have to say? Big risk, big return. You don't make risks, you make no money, that sort of thing. Right. So again, we're trying to get you out there, to get out of your comfort zone. This is what you need to do this summer, not just lock it up and go away until Labor Day. You're going to miss the opportunities that are there this summer. Okay. And the last one, and we'll wrap it up for the show. Slow and steady wins the race.
Robert Lloyd.
Robert Lloyd. I don't even know who that is. And
I'm so random.
heck of a job there, Brooke. Fantastic. Yes, Robert Lloyd. Slow and steady wins the race. And we've heard this forever and a day.
Right.
You hear it.
You do.
Right. So this is who said it. And this is how it is. So don't be trying to get rich quick. Don't be trying to, just sell the rips and buy the dips. You do want to long-term, invest, not trade. But for now, we've given you not 10, but 11 investment ideas for the summer of 2022. And good luck to you. And good luck to you.
Happy summer.
Happy summer.
Almost,
for sure.
Right?
So anything else to wrap up the show?
I think the one thing that through all of this, what you've said is do your research, right?
Do your
I
research.
think that's key for the summer. Don't just leave it alone. Do your research, know what you're getting, know what you want, right?
Just like anything else, hire a professional, find professional help. I mean, this is the time that if you go it alone, if you fail to plan, you plan to fail. So have a plan, find a professional to help you. We have on our website tools, calculators, presentations, white papers. Just go to greatlakeswealth.us. At the bottom, there's a whole list of videos and, articles. And if you want to do the work, it's all there. You don't even have to Google anything. Just go there and start typing in. If not, go find a professional financial planner, talk to your accounting team, your legal team, and get it all set and absolutely do your work. And you should be exciting. This could be the investment opportunity of your lifetime.
Excellent. Thank you, Dewey.
With that, I guess we'll call it a show.
I guess so. Yeah. Thank you.
Okay. Well, we'll see you next time, podcast listeners, YouTube viewers. And we'll remind everyone one more time to please subscribe, hit that like button, the subscribe button,
share,
download, and absolutely share. It's with this amazing community that we're able to do what we do. And we'll be back for episode 21 shortly. But with that, episode 20 is in the books.
All right.
And we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.